Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Wednesday, June 4th, 2025. It's 9:40 a.m. Eastern Time. So I'm starting the video, and here's what I'm going to do in this one. Do it a little bit different, and some of the same. I'll start out with the equity markets. Quick overview, not too much of a deep dive. Not a lot has changed in the last few weeks. But I'm going to give you my thoughts there. Key levels and developments to watch for, which may change the near term and potential longer term trajectory of the markets. Then I'm going to just spend the bulk of the video talking about and looking at different fundamental indicators. In other words, economic indicators and also potential fundamental catalysts. I want to talk about that, things that could move the markets here in the coming week or so. I'm going to go to the economic calendar for this week. I think there's a lot there. And then I'm going to talk a little bit about what's going on as far as the trade wars go and US, China, and all that good stuff. So, all right, the markets. I'm going to start out here with VTI. Every now and then I like to loop to this one. This is if there's a single ETF out there that is representative of the stock market. When people talk about the stock market, CNBC just still continues to talk about the Dow. Oh, the Dow's up, Dow's this. The Dow is nothing. It's an antiquated index that baffles me why it's even talked about today anymore. It's 30 stocks. How representative of the U.S. economy or the entire stock market are 30 stocks? Recently, the Dow was severely underperforming because United Healthcare, which had a big weighting, was going down, and so it's kind of skewed the whole performance there. So VTI is the Vanguard Total Stock Market ETF. It's pretty much the Wilshire, it tracks the Wilshire 5000. It's tracks the investment performance, they say, of the CRSP US Total Market Index, which represents approximately 100% of the investable US stock market. Includes large cap, mid cap, small cap, and micro cap stocks regularly traded on the NYSE and NASDAQ. So, and the way they do it is by invest in a sampling of the index. So, anywho, that's kind of the stock market. So where we're at right there is we're still within spitting distance of new all-time highs, as I've said with the S&P 500, which I'll get to in a second on SPY. Once we took out the 200-day moving averages, it certainly spiked up, increased the odds that we could see new highs. I still keep those odds about 50%, maybe a little higher, only because the stock market has a track record, a history in recent years, even recent decades, when it, after a big correction or even a bear market, when it gets to near new highs, it usually, not always, but usually pops through those highs. But a good exception, one in recent memory, at least for one index, was the NASDAQ 100. If you recall the 2022 bear market, the NASDAQ 100, I'll get to that in a second. It peaked in November, I think it was, of 2021, almost, but failed to make a new high in the beginning of the year in 2022. At the same time, the S&P 500 made a new high. So let me just give you a quick overview. So there's VTI. Again, if we fall back below the 200s on VTI, and this level right here, that's the big level. I'm even going to set a price alert now. I don't cover VTI often, but let me just... that level right there, about 279 is where it's at. I have it at 278.96. You can see a big old gap right there. And if I turn off the lines at 200s, and this is the story of lately. So again, I've cut back on trade ideas have been relatively light. We've got some out there, some some that have been on a while. But if you are frustrated, if you're not happy with the lack of trade ideas on the site, or if you're unhappy with your own trading, you just realize it's a function of this. When the market goes sideways, nobody's happy. Bulls aren't happy. Bears aren't happy. Swing traders, somebody mentioned recently, I saw a comment I replied to yesterday. They posted a short-term setup on the 15-minute charts. They said they saw some divergence on NQ, and NQ popped yesterday. Sure, an active trader, if that's in your wheelhouse, you can game these little zigs and zags within there. But again, make no mistake about it, the stock market's pretty much gone sideways for the last over 3 weeks now, almost a month. And you had one little, in VTI, you had one little dip down here back below the 200-day simple, and that recent, it tried to pierce into that gap. This is a big old gap. big levels to watch, guys. So if you want to watch this one right here, you have the 200-day simple. You have the recent bottom of the trading range marked by the gap right here, this big gap that I'm highlighting, the top of the gap right there. So if you enter that, if VTI were to fall back down there and gets into the gap, you'll probably get a gap backfill, which also coincides with the 200 exponential moving average. Anything down below that, I think, will be the catalyst for the next leg down. Otherwise, you still have the potential for right now. I'd be a fool otherwise to say that, this market can't punch out the new highs, because again, we're relatively close, relatively 3% or so. You have negative divergence, overbought conditions, as I often state, with a high degree of confidence, only because it's time has showed me this, that breakouts that occur with overbought conditions and negative divergence have a much higher rate of failing. So while I might have the odds at 50 or just higher than 50%, I think any new high will be a marginal new high followed by another drop. That's been the MO for the market for years. It's happened right here. Punched out, made a new high, and then a big drop. And so again, the RR, in other words, 3 to 5, 6, 7% before the next drop just isn't very favorable on the long side. So hopefully that makes sense to you. So even if I'd put odds better than 50%, it's just not a lot of upside to pop that. It's just the markets want to do that. It's almost like a gravitational pull when you get there. But again, I do have to caution you, as with the NASDAQ 100, here, we'll get to that, in 2021 and then early 2022. We made a all-time high right there, and ever so slightly, at least in the futures, you know what, I'll tell you what, no, that's not it, guys. I'm sorry. That was then, I'm on it. I was zoomed in so tight. This was it right here, and you got to go back like this. There it is. Now you can see it. I believe you can see it. It was a big bearish engulfing high. I pointed that out at the time, followed by a trendline break, sell signal there. And so the NASDAQ failed. It fell, got very close within spitting distance again, but failed to make that new high. S&P made it ever so slightly marginal new high back then, and then that was it. So again, that tends to be, it had a very almost identical technical posture, negative divergence. We had a divergent high there. It's not as if it didn't play out. It did play out for a correction. That next high was another divergent high. It simply extended the divergence. It started at this point, another big correction, probably high single digits, maybe double digit drop, followed by one final, and it kept the divergence going. And then we all know what happened in 2022. We had a first bear market in a while. And here we are today, SPY in the same trading range, and we just box it in. We're a hair above it right now, but just like here, this is really the bottom of the trading range. We had one little whipsaw down below, kissed the 200-day moving average, and this is a slight move above the recent highs. Again, like I said, within spitting distance to tell you exactly to get to the highs, you got to go about another 3% should do it. And again, in my opinion, even though the odds are pretty good there, and if you want to, the way to chase it, if you want to get 3%, it's not bad for a short-term swing trader. Just keep stops relatively tight, because if we fall back into this trading range here, this multi-week trading range, you're probably going to go back down to the bottom. That tends to be the MO when you're in a trading range. It's a simple strategy. You buy the bottom and you sell the top of the range. In other words, short the top. And if you get a breakout in either direction, that could be, and often that is, a sell signal break to the downside as a breakout to the upside. But if that fails, you have to be quick. You reverse, recognize that it failed. So that's what I'm looking at here. So if we go down, and you could drill down on a 60-minute chart and see the range even a little better. This is SPY on the 60-minute chart. Again, this is you can see pretty clear. We had an uptrend line right here. It's a breakdown and back test. It's a marginal new and still divergent high right now. And there's that trading range with a big old gap down below. So that's it. Set alerts, trade accordingly. If we do break the bottom of the range, at minimum a gap backfill, and you already have QQQs on this board right here with the trading ranges and targets and all that, This is the bottom of the trading range. Remember, we hit, it looks like we didn't hit it there. We hit it in pre-market. That was T1 right there, 502.88. Always cover a little bit above the actual support level. And so that's the bottom, also the bottom of the gap. It was not a random level. There was a technical level. That's where I expected a bounce, a reaction on the initial tag. And this is the gap right here. So I have T2 a little bit above the bottom of the gap. And we're not going to get there unless we break this trend line. So, and I do think it'll be broken. This is a beautiful, beautiful bearish rising wedge. I've spoke repeatedly to this stop, which was initially a stop if you were only targeting T2 and you shorted right here when I first put the trade out. That gave you a nice RR, risk reward ratio to T2, but I've since added different targets and said, again, depending on your entry price, whether or not you covered on T1, game the bounce, you may opt for a wider stop, and most certainly would make sense if you're going for, again, these are just swing targets, but remember the way this works is if, and again, a big if, we break down from this wedge and we start to move down and we go down to T4. I've talked about this already. T4 is at about, it's a zone that runs from about 468 and a quarter down to 460, 480. So we'll call that, let's just call that 465 or 466. Then I toggle over to the daily chart. What will 466 look like? Well, it's going to take us right back to the bottom of my bounce target zone, also take us back below the 200s, which then, to me, in my opinion, as I've been stating, that's what I want to see to add to long-term swing short positions, because I think not only, will we get there, one of the things I like to do, and I do often, if you follow me for a while, I don't just give price targets. A lot of folks out there are always throwing out price targets. There are no guarantee any of mine will be hit, but if so, what happened here? We're on a weekly, something's changed. Give me 1 second. There it is. I was on the wrong board. If all that happens, again, it's a big if, but it could happen in days. And I'm going to go over the economic potential catalysts here in a second from a fundamental perspective. Maintained these targets for quite a while, since back here. We hit T1, we gamed the bounce, then we hit T2, we had a bounce, got long there, didn't game all of it, but a good part of it. Then we were short again here, we hit T3, again covered. And so this is all a, just a different iteration of the same trade. And the next target I have, still T4. And then, however, I think we'll see a fast move down if and when, again, guys, conditional stuff. If this, then that, right? That's an app you can download on your phone. It's a great little automation app called If This, Then That. Triggers one thing, triggers another. So if the 200s get taken out, clearly get taken out, I think we'll start to waterfall down. It'll be kind of a strap-on, quick move down to T4. Could even blow down through T4 and go to T5 with very little, if any, reaction. But if we never take out the 200s and we go to new highs, and then maybe something else is going on, divergences start to get taken out. But as I've repeatedly stated, any new high anytime soon will simply extend the divergences, and I still have a high degree of confidence it will be just that, a marginal, meaning relatively slight new high over that previous high, based on the technical posture, right? All right, so now let's kind of move over to fundamentals in the market. Things to watch for. I'll make some predictions on some of these. But again, if these predictions, again, if this, then that, you have to do this for the other thing to happen. And one of those, as I've been stating repeatedly, since here, I believe we're in a new, secular bull market in rates, and I do think rates will continue to rise. We have Trump's big bloated bill, which is trying to get forced through. They're looking for a early July. There's going to be a lot of back and forth on that. As you know, it's there. It's meeting some opposition right now with a couple senators kind of saying hard no until you make some changes. We'll see. That is certainly a big potential catalyst, bullish or bearish, for the markets. If it goes through, it's supposed to be stimulative for the economy. We'll see. Again, too many back and forths before if and when and how it gets approved. So I'm not even going to comment on it much more than that. Just keep an eye on it. That's one thing. There's some other things that I think are going to between now and July, when if that, or if it does or doesn't get passed, in whatever version or iteration that it's going to be in at that time. We'll talk about it then, okay? But right now, this is what I've been highlighting here. We have this high level consolidation. Rates have been stubbornly bullish. What you're looking at is a yield on the 30-year bond. And again, we are just like the stock market. And this is the crazy thing here. It's going to be one or the other. You can't have both, in my opinion. I feel very strong on that. If Treasury yields break out to multi-year, potentially even multi-decade highs, I'm going to take this line across and just show you. We'll be going back to right here. This is the 90s, guys. Think the dot-com bubble, 1998, when I take that line across where yields were. So a breakout above there could take us up to where rates were back right here in the early to mid 90s, right? We're already at where we were in the financial crisis hit right here, right before the financial crisis. You can see the year breaks down here, 2007, that's when the market peaked. And so this is huge. So, to me, again, and the markets will maneuver and they'll adapt, but we've seen, and I've talked on it repeatedly, on how the Fed has pretty much lost control of the long end of the yield curve, and that's one reason I think they've cowed down. They're afraid to do much or talk about much. 3 rate cuts. This is historic. They started cutting right there. And instead of rates going down, remember, of course, they don't cut the 30-year bond rate. They cut the federal funds rate. That's an overnight lending rate. But historically, when they cut short-term rates, long-term rates have also fallen. And what they saw is the opposite effect happening here. And here we are after 3 rate cuts, and yields going the other way. And again, so the risks right now, in my opinion, are not bilateral. They are skewed to the downside because treasuries are so high. If treasuries back off, and they back off in an organic manner, meaning not a risk-on trade where the market starts going down, some of these risks I'm about to get into do play out in the coming weeks to months, then that would be help support the case for a sustained breakout in the stock market. But if this breaks out, and it's hard to imagine, because if the market breaks out to do highs, and let's say it sticks, and the assumption is earnings are going to be good, the economy's on strong footing, it doesn't make sense because long-term treasury yields rates have always been dictated by future growth expectations. So it would only make sense that if that happens and the economy breaks out and the analysts are all bullish and earnings are going to be higher and the economy is strong and there's no chance of a recession in the foreseeable future, it would only stand to reason, at least in the past, long-term rates are going to go up. So what I see is almost a ceiling on the stock market right now for that reason, if you follow that line of thinking. So we'll see. All I can tell you right now, again, this can go either way, and I can certainly, and have made a case, you can see rates come down. When I look at this is TLT, I just flipped in reverse. TYX is the yield on the 30-year bond. These are the prices. And so, I note down here, you have positive divergence. You have a divergent low right here, big divergence. You had a breakout right there. This is of the downtrend line. And so breakout and a back test. So that just looking at the chart alone would indicate that we rally. And normally I might take this breakout. You know me, I've had a lot of trades. We batted damn near 1,000 on our treasury trades for the last few years now. I'm just kind of at this point in time with what's going on, I'm a little bit suspect of this breakout. Thinking it may fail again. We're so close there. And there's so much going on, which I'm about to get to on the economic front, that could foil that breakout. And if it does, it's going to be a massive move, because this is a beautiful bullish setup. It's one that I normally take. You guys know me, you know my trading style. I love these divergent highs and lows on treasury bonds. We've been trading the snot out of these things for the last several years. And this is a divergent low right here, big divergent low. There's that breakout. I just dropped down to a 60-minute chart here is all I did right there. And so that's what it should do, quote unquote. But I'm suspecting this is kind of, I'm not a purely mechanical trader. I trade on, I factor in, gut feel, instinct. If something doesn't smell or feel right, I don't have to go against it. I'm not short treasuries right now. I'm just at this point in time, I'm watching these, as I've been stating for the last few weeks, as what could go on in the market. So let's move on here. I got a lot I want to cover. Okay, so let's talk about economic events. And I will make some predictions here, and these predictions are based on the charts. I still maintain my longer term targets. I, even though statistically I think being so close to the highs, that's why I said 50-50, maybe slightly better than a 50% chance of new highs. Any of these can knock that scenario out and give us what we got with the NASDAQ, what I just showed you back in late 2021, where it peaked there, looked like it was going to break out to new highs in the beginning of 2022, but fell short. And its employment, to me, is a big thing. There are two things: employment and the trade wars. I'm going to start with employment. This is the economic calendar. This is the ADP employment report right here, 8:15 a.m. today. You can access this on right side of the chart under resources in the top menu, and then go down to tools of the trade. I'm seeing something that the rest of the world doesn't see, and I've been talking about it. And when I listen to the pundits on TV, they say, yeah, there's a difference between the hard data and the soft data. Soft data is weak. But people, how they feel, sentiment, blah, blah, blah. But the economy is still strong. Jobs are on a solid footing. This was consensus today. And again, this is just one report. The consensus range was for ADP employment report, private payrolls, month over month numbers. So, from this month to last month. The consensus was between 70 to 180,000 new jobs, with the consensus midpoint of 110, came in at 37, so much weaker than expected. One report. This market's been, in an uptrend and a bull trend. Remember, the market will treat good news as good news. It will treat good news as good news, and often shrug off bad news or somehow spin it to good news. In other words, a weak employment number could be, if you want to, you have that confirmation bias and you want to spin it as bullish, you'll say, oh, well, that's going to increase the chance of a Fed rate cut. And yes, it technically does, but I'm going to get to all that in 1 second. All right, so that's that. Watch this. Watch, you got ISM coming up today at 10 o'clock. Right now, that just hit. So let's take a look. I didn't realize that as I was starting the video. ISM consensus was 52. And the actual came in at 49. That's recessionary. You can see that's service businesses, and they talk about it when you go down here, the definition, why investors care. If you want to read up on it, you can do that. So, reading above 50% indicates the service economy is expanding, and below 50% it's declining. So that's what we got today. So, the experts, not a single one of them thought it would be shrinking, and it's nothing big, but it is a downtrend. So again, I follow trends. One single data point can be dismissed as a one-off kind of thing, but I'll get to the trends here in a second for you as I go to these numbers. So there's that. Let's go back to the calendar. Let me shrink that back down so you can see everything. And so check. Two negative, reports today that missed expectations. Big one here, guys, coming up: jobless claims tomorrow and the employment situation on Friday. So, again, if we're going to see any catalysts on the calendar this week, we've already had a couple. Nothing big. Market's flat as I speak, literally flat. I'm looking at the NASDAQ futures trading at 0.00 as I talk at this second. So again, let's call these non-events. We were up a little earlier, knocked them down. Again, these are potential catalysts. And look, that can go either way, guys. The way I think is that ultimately you're going to need to see a fundamental catalyst to make the technicals play out. The big divergences and other things that I'm looking at there. So these are both catalysts. That can go the other way. Let's recognize that. And if we're going to go to new highs, maybe that, the market, it can happen in one or two ways. Maybe jobless claims spike, or the employment numbers are bad. And instead of dropping, maybe an initial drop, the market rallies. Why? Because they're going to say, because the Fed, it increases the chance of Fed rate cuts this year. Well, okay, yes, but for the wrong reasons. In other words, be careful what you wish for. If this market starts wishing for bad economic numbers, if you guys, I've said this many times, and this is not opinion, this is fact. Consumer spending accounts for 2/3 of GDP. So as much as Trump's big bloated bill will, add, and may help the economy, the government can spend all they want, but they're pissing into the wind because the government spending is less than a third of accounting for less than a third of GDP. So when folks lose their jobs, there's never been a point in history you see jobless start to, the jobless numbers spike, unemployment spiking, and you don't see a recession. I'm going to get to that in a second. Why don't we just jump into that? All right, let's do that. Okay, so there are many types of ways to look at unemployment. You can go to this site here, macrotrends.net, one of my favorite. You can look at the national unemployment rate, which I have right here, going back as far as we want. I'm going to zoom in so you can see it nice and well in the video. And again, I've been talking about this now for a while. These things, these long-term trends, when you're calling for a bull market or a bear market, and you're seeing economic indicators start to turn and support that, please understand there's a lag time. You're talking periods measured in months. And what I've covered many times in the past, if you look at this chart, all these gray lines, you can hopefully see them in the video. If you can't, you need a better monitor, or, instead of watching on your phone, use an iPad. There's one right there. That's COVID. Those are recessions, all these gray areas. And without fail, two things have happened. The bull's case has been, and I get it, record low unemployment, right? Well, all recessions start not from record high unemployment, but from record low, right around these levels here, okay? So that's number one. Okay, so you say, well, okay, Randy, but that's, it can take a long time. Yes, but when you fall to that level, with zero exceptions, you go down and you never stay there. I challenge you to find a point where you hit record low unemployment and you didn't see a V bottom, right? Again, relatively speaking, we're talking a chart here that goes back 70 plus years. This is 1950, 60, 70. These are decades. But you can see the bottom, and they're V bottoms. And once the turn is in, and don't look for the turn up here, here, here. Look for it down here, record low levels, around 4%, give or take. And especially in recent years. And that's it. And then when the V comes, when the turn comes, and once it becomes clear it's not a blip, these are aberration, little blips along the way, right? None of those are turns. The turns you can see once you have a series, when you zoom in a little tighter, I can do that here, we can do here, we'll do it here. You can see when you start, this is an uptrend, a series of higher lows and higher highs. So to me, again, I'm baffled that it's not being talked about. It's being shrugged off, and most analysts, the vast majority right now, are not pricing on a recession for this year. They're pricing new highs in the market, no recession. This is an even better one to look at. Again, if you go into macro trends, go to the U6 unemployment rate, because it has a little bit more, it's a little more granular. You have both the official unemployment rate, the U3, you have the U5, which includes discouraged workers and other marginally attached workers, and then U6, which adds in workers who are part-time purely for economic reasons. Think about the folks that got laid off and now are working two jobs to make ends meet, but they're not getting benefits because they can't find a full-time job with benefits. And again, you don't have to be an expert economist to analyze this chart and see what I'm seeing here. These are the last, this is as far back as it goes, recession, and this is when the NASDAQ fell 78% back in 2000. The S&P given fell less, it was more of a tap, but it was still a pretty vicious bear market. This is the financial crisis. Both the NASDAQ and the S&P fell about 56% back then. And there's COVID, a recession that was interrupted, would have been a lot worse without all the excessive stimulus that has taken the market and the economy where it is. But you can see, guys, the turns come first, right? The turn comes first in all of these, then comes the recession. The turn comes, and there is a lag time, and it can be a good year or plus. Not much more than that. COVID was kind of a unique situation, employment wise, obviously, because the global economy got shut down. But again, the turn has been in. This is not an aberration. These lines right here, these are little or spikes. These are little spikes. This is a trend change. And at no point in history have I seen it do that and then turn back down and stay low. Record low employment for 4 or 5 years. It's just, maybe we'll get that. Maybe this will be a first. I don't think so, but that's certainly possible. Okay, guys, so only time will tell. However, my point is continue to watch the unemployment, the numbers as they come in. Could be this week. Maybe they come in bullish this week. Maybe the market's reaction. And that's the thing, too. I've seen these times where you can see the macro data deteriorate, but then the market rally is going to keep going because it wants to go, and it's going to take bad news, as I said earlier, and spin it around as good news, only because you're going to get your beloved Fed rate cuts. Fed rate cuts will come this year. Oh, I believe me, as will a recession. And again, be careful what you look for. All right, this is credit spreads. This is something I don't, I've heard people talk about this, even, some of the big names out there, including Jamie Dimon, warning about this. I think credit spreads will blow out. And I think credit spreads are but what I don't hear being talked about is why credit spreads haven't blown out yet. And one reason I think it's giving this the stock market this kind of extra life, if you will, is because I think it's giving the markets a false guise of strength. And for you, those of you not familiar what credit spreads are, it's the differential or the difference being paid between risk-free government bonds, i.e. treasuries, and below investment grade, i.e. junk bonds. Low quality, but these are companies, a lot of them by name, but they're just rated below investment grade. And so what happens is smart money will watch that for clues. This is, remember the dot-com bubble back here, popped in March of 2000s when the NASDAQ peaked, and then the bear market started, but credit spreads were already rising, meaning smart money who watches the bond market knew under the hood, even though the stock market was ripping and screaming higher up to that point, credit spreads were going up, saying that that those lower grade bonds were demanding higher and higher rates, saying something's wrong in the corporate world. All right, so at most points in time, in fact, any point in time up until recent history, that was a very clear, easy way to see that, and you saw it back before the financial crisis. This is really where they peaked. Credit spreads made a lower high and then started moving up before the recession began. This was COVID. There was a little bit of a heads up, but not much, because again, COVID was kind of a one-off, came quick. And yeah, credit spreads went down to next to nothing, record lows after COVID due to all the backstops. The Fed intervened in ways they never had before. They pulled out, invoked emergency powers to exceed their typical charter. They were able to buy junk bonds. They were able to buy the angel, what do they call it? The ones that were recently junk and were on the line, close to being junk. In other words, all grades of corporate bonds. They were able to go outside their typical purview and support the financial markets. So there was virtually no risk because the Fed had an unlimited backstop due to emergency power. So, but that's typically where they go down. So since then, rates have normalized. But you can see lately, this is not flashing any warning signs. And one reason for that, in my opinion, is the fact that we're seeing an unprecedented divergence between, for the first time in history, the risk is not with corporations, or at least they're not being priced in. LQD, or your investment grade bonds. And I just pulled that up. So if you look at this chart here, we're going back. This is a daily chart. You can see in recent years, this is where we peaked. We peaked here. This was that recent sell-off that we had this year. This was the beginning of 2025. This is when the markets were selling off. And so corporate bonds are holding up. They're holding up these recent lows here. But you have treasuries, as I showed you. Let's just go to the 10-year. That's probably more apples to apples. We'll go to IEF. You can see treasuries, and especially TLT, have been telling a different story. So what you're getting, again, this is unprecedented. We haven't seen this at other points in history. Treasuries now are the ones that the markets are more worried about because the U.S. our debt situation. So as Treasury yields fall, or Treasury yields go up, I should say, they're going up more relative to corporates, and then that's making these spreads look better than they probably are or should be. Again, that's just something to watch and something to factor in there. That this is kind of a unique and very odd situation. So I think it's kind of masking what may really be going on in the credit markets. Only time will tell. I still predict there'll be a blowout of credit spreads at some point, but maybe not. Maybe if we bust out and Trump's big bloated bill gets pushed through, treasuries break out the new highs. Nobody wants to buy them. Foreigners don't want to buy them. So treasury bond prices drop with yields spiking. Again, you could see corporate yields, corporate interest rates going up, especially the lower graded bonds going up as well. But if you have treasuries shooting up, we're normally in that situation. If we hit a stock market start going down, you're going to see treasury yields dropping as investors buy them. This time around, you could see the opposite. So in that case, credit spreads are never going to really expand or diverge as they have in the past. So just keep an eye on that. And again, these are uncharted waters, really, unprecedented times in the credit markets. Okay, I had to pause the video there for something, and I think I was just talking about the, what to watch and with treasuries and what can make them go up, and also the fact that the market may be putting a little too much into the relatively low credit spreads right now. Again, based on what treasuries are doing, when normally we weren't looking at such huge federal deficits, we'd probably see yields quite a bit lower right now. Okay, and before we move away from treasury bonds, I want to just talk on one more signal derived from treasuries. And I'm going to loop that in first, or segue into it, by starting out with, I had a couple folks on the site at least that wanted to, harped on the Zweig breath thrust indicator that fired back right here. I think, let me change my tools. It was on I think that was April 29th, I think it was, or that Friday right here. So the next trading day, you get the signal only after the day closes. And either way, it's the same difference. You would have, had you taken it right there, that would either the close on that day, Friday, or the following Monday, would close at the same level. And I just wanted to kind of talk on that, and then the one that I'm about to get to. So supposedly that one has a perfect track record. Quite a few folks jumped on the stock market, at least the S&P 500, or we can look at VTI. It was probably a little lower because it does have a lower weighting in the index. So let's just see what day that was. Monday the 28th. So the S&P 500 is up 8%. Not bad, but let's not forget, on the morning of April 7th at the lows, in the comment section, I had replied to someone after going long, covering all my shorts and going to a full long position, reiterated that very day. So from the bottom of the market, long before that came, was technical and fundamental analysis. We had a 14% rally up to that point. So again, from there, we've only rallied 8%. So again, there's different styles, and maybe this thing will call, it's supposed to call, major trend changes, major bull markets. So if the market does rally another 20, 30, 40%, then heck yes, that was a great signal, and it'll keep its track record. So far, 8%. And again, if you look at VTI and you go back there, you're probably going to see about the same thing, about 8%. So roughly half of what the move was. It was a 16% move up to that point. So more than twice the gains were already made off the low. We'll see if that signal pans out, but so far I wouldn't. Only time will tell. But let me show you one that is based off, again, we were talking about treasury bonds, and one that has so far an infallible track record. And I want to do this because I haven't heard anybody talking about it. Again, I don't watch a lot of. I get most of my news off the the reading on the feeds off the financial media online. Once in a blue moon, I'll turn on Bloomberg or CNBC, see what they're saying there. But I don't hear anybody talking about the yield curve lately. For those of you not familiar, what the yield curve is the difference between short-term and longer-term treasuries. So you've got different. Some will look at the 1 year versus or the 2 year treasury bond versus the 10 or the 30 year. In a normal economy, in most points in time, you have what's called a positive yield curve, where longer term rates are going to be paying more than short term rates, right? That only makes sense, right? You're not going to want to lock your money up. The markets will demand that treasury bonds pay them more if they're locking up and taking the risk of tying their money up for 20, 30 years versus a 1 month T-bill or a 6 month or 1 year. But at a few points in time, and almost invariably before recessions, the yield curve inverts. And there was a lot of talk on that a couple years ago. And again, I was talking about this at the time as well, but also stating that a lot of the pundits come out on TV just don't get it, that it's not the inverted yield curve that is first. And this indicator has a perfect track record. But again, quite a few have already dismissed it as the one time it didn't work, and maybe that'll prove to be the case. We'll see. Only time will tell. But let me zoom back in here. Sorry, all the pop-ups here. I can't control that. So what I've said repeatedly, this is what the zero line right here. So this is when the yield curve inverts, and this one here is the 10-year treasury versus the 1 year, right? So what happens when this line drops long-term? 10-year treasury bond rates have dropped below the what the 1 year is paying. And the shaded lines, hopefully you can see them. If not, this site is Guru Focus. You can create a free account there to get to this. These are all the recessions, these gray lines. And again, this has a perfect track record. It's predicted the last recessions with a 0 failure rate. And again, what I always say is, they talk about it, that the recessions, and it's true, the recessions do follow the yield curve inversions, always have, again, without exception. But that when you want to use it more of a timing indicator, it's the uninversion of the yield curve that coincides with the start of the recession. So the yield curve can get, and often does get, inverted. And finally, when you cross that line here, well, let's look at the 10 2-year right here as well. You can see it's when the yield curve uninverts or crosses back above the zero line. That's when the recession is a little more imminent, if you will. There it kissed right there, COVID. So what happened is we inverted back here. It's been a while. And again, I and others talked about it back here. It's been quite a while, just like back here in the 80s. It inverted, and it took a while to uninvert right there. Then the recession followed. Then we had another recession right there. And so I just wanted to mention that we've only just recently, as you can see from these charts here, just recently uninverted. So this indicator has not yet failed at all, because it appears, again, going back in history, that a recession now is imminent, most likely at this point, because we've just only recently uninverted, and most likely means the recession will be when imminent. Again, when you're talking a chart that spans decades here, and you look at these signals, imminent would be within a year, give or take, somewhere in there, year and a half, once you get the uninversion. So I just want to mention that has now happened, and especially more recently in the both of them, the 10-1 and the 10-2 right here, complete uninversion of the yield curve. And you can go around, play around on that site. So I wanted to make mention there. So there's one with a so far a perfect track record. And now I will say this: if we don't, now that it's uninverted, if we don't have a recession within the next year or two, then yeah, this one will go down in history. Maybe it's true. Maybe now it's distorted and that one no longer works. Maybe the Zieg breadth thrust indicator keeps its track record, or not. I don't know. I put a whole lot more into the technicals, especially something with very few signals you have to take with a grain of salt. If you're a statistician, you have to have that larger sampling pool to say, something with only a handful of triggers over the last few years, whether it's going to continue to work or not. So I wanted to point that one out. Now let's move on, if you're still with me, let's talk about, again, these are going to be fundamental ramblings. Let's talk about the trade wars. So Herman Munster has posted this and has provided us a couple updates. I believe he's in the trucking industry, if I'm not mistaken, and has been sharing some real-time data from the field. And so this one got an update from purchasing. We shut down the second week of July for lack of rare earth magnets from China. It's just too late to put magnets on the ocean. And so they're already shutting down. They know the magnets aren't coming. And that was a couple days ago. Thank you again so much. Please keep these updates coming. I find a lot of value because this is real-time boots on the ground kind of stuff, not just, op-ed pieces in the financial media. And you can see here that coincides with this article that came out. This is dated yesterday in the Wall Street Journal. Automakers race to find a workaround to China's stranglehold on rare earth magnets. Major manufacturers fearful they will have to shut down assembly lines, consider moving some production parts to China. You can read the article. Here's the key points. Automakers fear China's rare earth magnet export controls may halt car production within weeks. Auto firms consider shifting parts manufacturing to China to bypass export controls on rare earth magnets. So car makers are already weighing alternatives like older tech or feature removing features. Ford already stopped production of the Explorer. So the article goes on to say that, so what happened is they had that tentative agreement. And you've heard Trump come out lately and say China is reneging. Yeah, they're using a lot of red tape. They're not shipping the rare earth magnets. There's supposed to be a process to get approval, and then they'll go out, but they're not doing it. So I'm going to just say a few things here, and this is just these are my thoughts, my opinions, but and it's nothing to do with politics per se. This is just, if you will, my take on Trump. Personally, in my over half century on this earth, I've never once I cannot recall a politician in modern day history since I've been alive. We can go back and think of the crazies of the world, and Napoleon and Hitler, some of these other egomaniacs. But I can't think of anyone in modern history, at least in this country, that has an ego even remotely close to Trump's. I think we can all agree, like man, dislike him. His ego is bigger than the state of Texas. And so this is just my thoughts here. Everybody now knows the whole taco thing is out there. Even Trump's now, it's been brought to his attention. Okay, a man with a colossal ego, now he's being ridiculed. There's the whole taco thing. For those not familiar, it's been mentioned here. Trump always chickens out. I'm sorry, because before taco came out, I told you I had my own term that just saying that he always cows down, that he would cow down. Predicted, that's one reason I covered shorts at the lows recently and went long. I said he will cow down, and he did cow down. So the market calls it taco. Trump always chickens out, and now he's addressed that. He's infuriated. He doesn't like it. And so a man with a colossal ego, my prediction is the next time around, the market's going to dip on the next thing, big thing he does. So far, there's not been anything that's really rattled the market. And unlike previous times, because of his ego, he's not going to cow down. That's my call. That's my prediction. I may or may not be right. And so what I think will happen in the next big drop, when there is a big announcement, when he fires back, because China's playing hardball with him, they've got it. And again, they know that he's just a bunch of hot air, and he cows down. So they're not yielding to this. They're holding up the rare earth magnets, which can really put the brakes on everything. You guys know that. They're in phones. You can't make a cell phone without them. A lot of things. Auto, cars, here it is. So I think the next time around, you'll get that initial drop. But what happens, in my experience in the stock market, by the time a trend becomes apparent, a pattern in the market, such as the taco trade, that by the time it becomes mainstream and it's written in the papers and it's on the news and everybody's talking about, that's about exactly the time it stops working. So my prediction, the next time you will have a drop on the next big one. The next, he's announced a few things here and there, but the markets haven't really reacted. They're kind of almost not listening to him anymore. He's now lost, I think, all credibility when it comes to that. But if there is another down, you'll get the dip buyers because now everybody's waiting to buy the next taco trade. You buy the dip and then the market goes up. And so you'll get the initial reflexive bounce, but then I think we'll put in a lower high from that point. The market will bounce, but not back. It won't take out the previous highs. And then it'll take out the lows on the next leg down. And that's when people realize the Trump trade, the taco trade's not working anymore. And so that's basically it. So I think you have China. And, it's my experience. I think it's pretty well known. The Chinese as a whole, particularly the government, they're very logical thinking. They're not emotional. They're strategists. And Trump kind of came in hard like a bully, and they don't respond well to that. China themselves, again, I'm speaking of the Chinese government, is a bully. Look what's going on in the South China Sea. Look at the Philippines. If you guys have been reading about that, the Chinese Navy literally creating islands out there in Philippine international waters, blasting the Filipino Coast Guard ships with lasers, blocking flights to some of the islands out there. They're trying to carve out their own piece of China Sea that's pretty much belongs to the Philippines now and other nations. Vietnam, it's not the only one they're doing. So China is a kind of a bully. They're not the kind of nation that's going to cow down to Trump's demands. We're the biggest trading partner. We mean more to them than they mean to us. And so you're seeing that now, guys, and that's all. So all I'm trying to say here is you can see China already pushing back, and they're not yielding. This isn't going as Trump thought it would go. He thought he'd come in heavy and hard like a big bully with these high numbers, and it's not working so far. And now he's lost pretty much all credibility. The world is ridiculing him, and for that reason, he's probably going to double down just out of ego. And you probably won't see him conceding as much anymore because his current strategy doesn't seem to really be working. So, and we'll see what the market does if I'm right. And look, guys, those are just random predictions. I trade off the charts. A lot of what I've covered in this video was fundamentals, but then a lot of it was technicals and fundamentals such as treasuries. There's a reason the yield curve again inverts. It inverts ahead of a recession when those in the know, the smartest of smart money that trades the bond markets, that's where the highest level, of institutional investors are, and they're trading bonds, and they see the writing on the wall ahead of time. That's where you see treasury yields first fall on the long end, predicting the recession is coming, economic growth. We're towards the end of an expansionary cycle, and then, like I said, it uninverts shortly before the recession. Why is that? Two reasons. Number one is mainly because the Fed then starts cutting. And again, you're going to see the yield. Remember, the Fed doesn't even set the rate on the 3-year Treasury notes. 3 months, I'm sorry. 3 month is the shortest term on a Treasury bill, the shortest term issued. And even then, the Fed has no control over that rate. They only control and set the federal funds rate. The market will set those shorter term rates, but the market will predict what the Fed's going to do. Therefore, short term rates fall in anticipation of the impending Fed rate cut. So they're bringing down that expectation. Why does the Fed cut rates? Because of slowing economic growth. They see the writing on the wall. They see it before. So the market will first tell you what the Fed's going to do before the Fed tells you. And so that's why you get the uninversion of the yield curve. Because right now you're seeing long-term rates going up, and you're seeing short-term rates fall. And if you want to check, short-term rates, you can go to, FVX is the 5-year yield. You can look at that, or any of the, the various. There's even shorter-term Treasury ETFs out there. So you can see the shorter term of the yield curve is falling. That's the uninversion. That means that rate cuts are coming, guys, and they're probably coming sooner and more than most think. and not for the reasons the market wants it. Will cheer them on some occasions when you're going to get some bad economic data, especially on the employment front. Remember, as I started the video, historically that's been an unreversible trend. Not only unreversible, once the bottom's been in, you turn at first. I'll get back to that and we'll end the video here. So you turn at first, the turn comes, then it starts to accelerate. So you get a turn, a gradual, and then you can see the unemployment sharply accelerate as the recession starts to take grip. So right now we have the turn in, and so again, maybe I'll be wrong on my predictions, but watch those the jobs numbers come in, and as I said, jobs are everything. And so if you start to see a clear and sudden uptick, and it could be this week, it could be 2-3 months from now, that's when you get to that almost what I call a escape velocity, if you will, where it's done and there's no reversing that course. Then the recession runs its course. The Fed will continue to cut, but too much, a little too much, a little too late, and that's when the recession starts. And you're already seeing money moving into defensive issues. You're seeing outperformance, as I've highlighted in recent videos, among the recessionary sectors: healthcare, consumer staples, utilities, all holding up better. Tech is still running right now, had a little last minute surge, but tech will fall the hardest. That's a high growth sector, and that's where the biggest gains will be made, shorting the next, some of the biggest gains, shorting the next big drop in the markets. The tech sector should fall a lot more than a lot of other sectors. All right, I'm going to wrap it up here, get the video out to you guys, and we'll see. Let's see how the rest of the week goes. Like I said, we've got a lot of stuff on the economic calendar, and that may or may not be the next catalyst for anything going on. But we'll look at jobless claims tomorrow, 8:30, and the employment situation report Friday, also at 8:30. And we'll see if the market reacts to the beige book today. Fed's beige book at 2 p.m. Probably not, but we'll see. All right, I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.